Recent headlines are talking about an uptick in inflation, whether or not we're heading into recession. So in today's show, I want to talk about all of these headlines and what they mean to your Social Security, what they mean to your retirement, and strategies to utilize to just help make sure that your retirement plan continues to remain on track.
Welcome to the Your Life, Your Money podcast with Scott Searens, teaching you how to thrive in life, wealth, and retirement.
Welcome into the Retirement Show, all about your life, your money, and your taxes. And today, to help you with those things, we're going to be talking about inflation, recession, Social Security, and what all of that means to your retirement. I'm your host, Scott Searens, and my goal is to help you thrive in life, wealth, and retirement. As I mentioned, there's a lot of news or topics in the headlines recently about the recent uptick inflation. I swear sometimes the news has nothing else to talk about. So what do is they take these little things that are happening, going on, and they blow them up. They make them into big things. And then because of this recent uptick in inflation, then it's going into other headlines that I've read. Are we headed into a recession or are we not? And then because of all the talk about inflation and recession, then there's additional headlines about your Social Security. What's happening with Social Security? What are the projections? What kind of increase would you be getting? Because of the talk about recession, what does all of that mean to your retirement planning? So I thought we'd just take some time, break all this down, keep it nice and simple, help you understand what does inflation mean and what does that mean to your future? What does that mean to your Social Security? Are we headed into a recession or not? Does anybody really know? And what could potentially drive the recession? What are some economic indicators going on right now in our economy here in the United States? And then whether or not we're heading into recession, just what does that mean from your retirement plan, for your retirement plan, and what strategies should you have in place based on what we're hearing in the news today? So let's just start first off with understanding some different topics that will help you recognize what's going to take place with your Social Security. That'll help you understand this talk in regards to recession. So first off, yes, I've seen some headlines out there in regards to the recent uptick in inflation. Before we even talk about all of the data, and we're not going to get lost in the data today, just talk about numbers so you can see comparisons to where we're at today and then where we were at maybe years and years ago, because it'll help you understand that maybe we're actually just in a comparable situation. Like things aren't way off today. Things aren't too different today. But some cases they might be, some cases they might not be. But let's start off with inflation. What is inflation? When you see inflation in the headlines, I know what you're thinking. Well, yeah, the cost of my groceries just went up. The cost of gas went up. My utilities have gone up. So let's first just simplify it. Let's go down to the definition of inflation, and then we'll talk about what all of that means to us. And then, as I had mentioned, stick around. We're going to relate this to Social Security. We're going to relate this to strategies for our retirement. So first off, inflation. Rather than looking at all these headlines in the news and trying to decipher them, what is inflation? And this is all from YCharts. I'm going to put the websites in the show notes so you can go to lifemoneyshow.com. Again, lifemoneyshow.com. And you can click on any of the links that I'm talking about during the show here today. So if I mention YCharts, we've got a few different links to them in the show notes today. We're going to have a couple links to some USA Today articles as well. So here we go. According to YCharts, the U.S. inflation rate is the percentage in which a chosen basket of goods and services purchased in the United States increases in price over a year. So chosen basket of goods and services. This could be groceries, services, utilities, gas. I mean, it's, again, basket of goods and services, things that consumers like us are using on the day-to-day to live and maintain our lifestyle. Back to the article here. Inflation is one of the metrics used by the U.S. Federal Reserve to gauge the health of the economy. U.S. Federal Reserve, we're going to talk about them next here. You've probably heard because of inflation, the U.S. Federal Reserve is raising interest rates. We'll get to that. But again, inflation is a metric used by them, and then they'll try to adjust interest rates back on that. So back to the thing on inflation here. Since 2012, the Federal Reserve has targeted a 2% inflation rate for the U.S. economy and may make changes to monetary policy if inflation is not within that range. Okay, one key thing here, targeted inflation rate of 2%. Now, does that mean it's going to be exactly 2%? Absolutely not. We're going to have times that go above, times that go below, but one of the things to recognize is that the cost of goods and services will continue to go up. And I want you to hold on to that piece there. We're going to talk about that in the retirement planning portion or strategies. Targeted 2% inflation rate. So they're not saying, hey, we're hoping the cost of goods and services will be flat for the rest of your life. They're saying we know the cost of goods and services are going to continue to go up, and we're targeting that they go up on an average of 2%. Okay, so where are we at today? Well, July of 2023, we're at 3.18%. What does that mean? That's in comparison to July of 2022, 3.18%. One of the things that I want to talk about is what they call recency bias. Recency bias is, our minds kind of think and feel based on what's happening right now. And so then we feel like it's always been happening that way. So same thing here with inflation. What's been happening lately? High inflation. A lot of times when speaking with clients, speaking with people, then they feel like, oh man, inflation's been really bad. Oh gosh, man, this inflation, the cost of goods and services going up, and it has over the last year. But I want to give you some historical data because when inflation was low, we weren't throwing our hands up and, celebrating that inflation was low. And so this is what I was mentioning earlier, that it's kind of all over the place. This 2% is a target for an average. But let me just give you a little bit of history here. August of 2020, inflation was 1.31%. August of 2020, 1.31%. But you see, in June of 2022, as we're all familiar with, last year, inflation was skyrocketing up. So it went up to 9.06%. Of course, we're going to feel the effects of that. Of course, we're going to feel that pain. But just remember, it's not always that way. June of 2023, so a year after that, 2.97%. July of 2023, 3.18%. So they're talking about this uptick in inflation. Sometimes people can try to find some, really creative ways to create a headline to say, oh, inflation's going right back up. But folks, look how close we are here. June of 2023, it was 2.97%. July of 2023, 3.18%. Those numbers, they're pretty darn close. I mean, it could be a rounding error and something, of the government studies. Who knows? But they're pretty darn close. So just because they're talking about an uptick in inflation, I don't think that this is something to be, going to bed worrying about each and every night. Okay. Now, inflation, as they had mentioned, is used by the Federal Reserve. Inflation's also used to determine Social Security increases. We'll talk about that in a little bit. And then it's used by the Federal Reserve to determine the federal funds rate. That then helps determine interest rates. That then could also, is why a lot of people talk about recession, because as they raise interest rates, does that then lead to recession? So let's talk about that for a second, the federal funds rate. So used by the Federal Reserve, the federal funds rate can drive a whole lot of things. So let's understand that. The federal funds rate, the effective federal funds rate is the rate set by the Federal Open Market Committee for banks to borrow funds from each other. The federal funds rate is extremely important because it can act as the benchmark to set other rates. Historically, the federal funds rate reaches high as 22.36%. Whoa. In 1981. That's right. In the 1980s, my parents were telling me about they could get CDs in the 18% range. I mean, unbelievable, right? Now, think about that today. How would you feel if the Federal Reserve kept jacking up the interest rates to 22.36%? I mean, it'd feel good for all that money that you have in the bank, but I'm guessing it would also scare you a little bit, because then would we go into this major recession? I don't know if that's going to happen. Personally, my opinion, I don't see that happening. They're just trying to get inflation again back to that 2% average. Okay. And it says, additionally, after the financial crisis in 2008-2009, the federal funds rate nearly reached zero when quantitative easing was put into effect. So the federal funds rate, as they had mentioned here, is extremely important because it's the rate that's set for banks to borrow funds from each other. So the rate that banks borrow from each other, but then it's also that guide for interest rates. It's that guide for loan rates. It's that guide for mortgage rates. So as you see the, Federal Reserve, they meet and then they come out and they say, okay, hey, we're going to raise interest rates by 1/4 of a point. Well, if you're in a online savings account, for instance, you're going to see that the interest rate then goes up because now these banks can also loan out money at a higher rate. If they're loaning out money at a higher rate, then they can pay you more interest for your money at a higher rate as well. Now, you might be wondering then, how does the federal funds rate, how does the government increasing this federal funds rate, which increases interest rates, how does that help lower inflation? How does that potentially lead to recession? Well, when they raise rates, not only does the interest rate in your online savings account go up, but then the rate that people can go to the banks and borrow money at, that goes up as well. What does that mean? Well, if those loan rates go up, people that are, let's just first off speak from a business standpoint. They raise those rates, those loan rates go up. Now it costs more money for a business to go to the bank and to borrow money. So if they had projects that they maybe had on their docket to do, maybe they have to start cutting those projects away because they can no longer at the rates, at the money, at what it's going to cost them to borrow money, that project may no longer be affordable in their company. They might not be able to make that expansion because of the cost to go and borrow money from the bank. So if they're not able to do those projects, if they're not able to make those expansions, then they have to keep their projects down, their production down, and they might not need to go out and hire additional people like they would have if they would have done those projects or those expansions. Sometimes they actually need to lay off because they might have to start canceling projects or expansions that they had. That's how it can lead to recession, is when they have to start doing those layoffs and then the unemployment rate goes up. From a consumer standpoint, now you might be thinking, well, wait a second, I've talked to you about debt, right? I'm just going to give you my personal opinions. Don't believe in debt and believe in paying off your debt and paying off those cards every month. But, that's not necessarily the opinions of everybody. So those that are borrowing money to maintain their lifestyle, well, now it's going to cost them a lot more to borrow money, which means spending will go down. Houses become a lot tougher to afford because mortgage interest rates go up, mortgage rates go up. So people aren't buying houses like they used to. So spending goes down, borrowing goes down, meaning that what they're consuming goes down. If what they're consuming goes down, that means demand goes down, supply goes up, and that's how prices get reduced. That's how inflation goes down. However, we're not totally seeing that, right? Because consumers are active in their spending, and we're going to talk about that a little bit here in the recession standpoint. So just wanted to give you that little bit of an overview in regards to kind of how inflation can lead to the Federal Reserve raising interest rates, how interest rates can then help tame inflation, but also could potentially lead to recession. And that's where they start talking about, hey, are we going to go into recession, or are we going to have what they call soft landing? And I'll talk about that in a little bit. And then the last economic indicator, again here from Y-Charts, that I want to discuss with you is the unemployment rate, because this is going to kind of come into play when we're talking about recession and what's taking place. So the unemployment rate, again, according to Y-Charts here, the U.S. unemployment rate measures the percentage of total employees in the United States that are a part of the labor force but are without a job. So people that can work but without a job. It is one of the most widely followed indicators of the health and U.S. labor market and the U.S. economy as a whole. Historically, the U.S. unemployment rate reached as high as 10.8% in 1982, 9.9% in November of 2009. Both of these times were noticeable recessionary periods. So, what's one of my takeaways from there? 2008, 2009 recessionary period, unemployment 9.9%. Here's why things are maybe kind of confusing. Rates are going up. The Federal Reserve is raising interest rates. Everybody's talking about recession. However, unemployment's still pretty low. And it makes it quite a confusing time, right? Because we've got tech companies that are laying off, but then if you go out there, there's also companies that are actively hiring and saying that it's tough to find people to fill the jobs that they need to fill at their companies. And if we look at the rates here in comparison to other recessionary periods, unemployment's pretty low. So they said 2009, unemployment around 9.9%. Pre-COVID, before all of this went down, right? Because it seems like COVID's also kind of what's thrown our economy into this kind of new thing that's going on. So pre-COVID, the unemployment rate was 4%. And where are we at today? According to Y Charts here, July 2023, 3.5%. So as everybody's screaming recession, I just want you to think about those unemployment rates. People are working. If people are working, people are spending money. So what does that really mean from a recession standpoint? As I had mentioned, lots of headlines going on. The uptick in inflation, hopefully so far we've taken that. We've said, yeah, the uptick's pretty small. It's actually no big deal. It's really small. What about recession, though? We're still seeing some headlines out there that say recession. So I thought I'd grab this article from USA Today. Again, link in the show notes, lifemoneyshow.com. Click on the show notes, and we'll have the link there. The article is titled, Is a Recession Coming, or Will It Be a Soft Landing? Pay attention to these market signals. So from the article itself, I'm going to read some and then kind of give you some of my thoughts and opinions here. But it's just, I thought, a good article that takes it right down the line and will help us just realize that nobody knows if a recession's coming or not. So from the article, a growing number of economists who had been forecasting a recession now believe the U.S. can achieve a soft landing. What that means is a gradual slowdown in growth that avoids a downturn. So what they're hoping is that they're seeing that, okay, we've raised interest rates, unemployment rates are staying low, and at the same time, inflation is lowering. So they call that a soft landing, a gradual slowdown in economic conditions, but without unemployment rates jumping back up into those 9, 10%, etc. All right, back to the article. Economists say there's a 50% chance of recession in the next 12 months, down from 56% chance that they said in July, and down from a 61% chance that they said in May. Well, good news there, right? Like all of these people that are predicting recession, looks like those are continuing to go away, down, down, down. According to a survey by Walters Kluwer Blue Chip Economic Indicators. Okay, that's where all those percentages came from. All right. Behind their brighter outlook is an economy that continues to churn out sturdy growth despite the Federal Reserve's sharpest flurry of interest rate hikes in 4 decades, combined with a more dramatic pullback in inflation recently. The latter, so inflation, lowers the odds of additional federal rate increases that would likely dampen economic activity in a bid to further tame inflation. And then they go on to talk about some economic indicators, which I want to tell you a little bit about those. And like I mentioned, what does all this mean to your Social Security and retirement strategies that you should have planned? So let me just pick out some highlights here. First off, to me, it's almost like this should be the predictor for everything, 50-50. There's a 50% chance of recession. There's a 50% chance that we're not going into recession. You know what? That's how we should always look at it, because that's kind of what could potentially happen. I mean, we could have down years in the stock market. We could have up years in the stock market. We look at history. History has shown us more up years than down years, just like history has shown us more good years than recessionary years. So it shouldn't even be 50% chance. They're just saying 50% chance now. I guess I should take that away, right? It shouldn't always be 50-50. But in this case, when people start shouting recession from the rooftops, we should still go at it like there's just a 50% chance of recession. Because if everybody thought that there was going to be a recession at the beginning of this year, and everybody was screaming it from the rooftops, tons of people, and if you would have taken all your money and moved it to cash, guess what? you would have missed out on some great market gains. The S&P 500 through mid-August is up over 15%. As you know, you can't invest directly into the S&P 500. It's a measure of the 500 largest stocks in the United States, but you can invest in indexes that replicate it. You could be up over 15% through August. Now, will that continue? Well, it could. It could continue to go up through the end of the year. I guess the 50% of the people that are still predicting recession would say that the market's going to go down. Again, nobody knows. That's why we're going to talk about retirement strategies that you should be utilizing, so that way you've got the right setup, whether the market goes up or goes down. Some of the indicators here that they mentioned that I just thought would be good to talk about, know about, is one, they said, hey, there's a solid economy. They talked about consumer and business spending doing really good, 2.6% growth since mid-2022. Growth is good. If we're in a recession, we'd be slowing down. So 2.6% growth means spending is up, manufacturing's up, hiring's up. Growth is good. And we've been growing since mid last year as everybody's been shouting recession from the rooftops. Healthy consumer spending, consumption, which is 70% of economic activity, rose 1.6% in the April through June quarter. That's 1.6% versus the quarter a year before. People wonder, well, is it stimulus money that's still growing the economy? I'm going to guess that stimulus money has maybe been out by now. So it's actually, my opinion, is it's consumer spending that's keeping the economy strong. They went on to talk about another economic indicator, business investments rebounding. As I had mentioned, higher interest rates drive higher rates to loan money, which typically drives business projects and expansions down. However, they are saying that businesses are still making purchases even with higher rates. So some good news there. They're seeing that, hey, they can still go out and do some of those projects. Maybe they're not doing all of them, which is that gradual slowdown. What they're talking about is a soft landing, but they're still doing some of them. Let's see. There's a full list of economic indicators. Again, you can get those at lifemoneyshow.com. I'll have the link there. They said slower but steady job growth. So again, companies are hiring, but maybe they're not hiring as much, or what they're doing is they just said, hey, we're not hiring, but what they're not doing is doing major layoffs. Some companies are, but some, instead of just doing hire, and then realize they hired too much and then just doing these major layoffs, maybe they've learned from the past. They're slowing their hiring or just not hiring so they don't have to do major layoffs. What else here? They talked about stricter lending. Lending criteria might be tightening because of some of the bank failures. So to me, that's a good thing as well. Just overall, when it comes to recession, look at it this way. Now we've got 50% of the people saying, yep, it's going to happen. We've got 50% of the economists saying, nope, it's not going to happen. They don't know, and they won't know until it either does happen or never does happen. And then those people are going to take credit because they guessed right. So it doesn't help to just sit there and stare at these articles and stare at these headlines, because as this shows, nobody knows. As it shows, people that were shouting it from the rooftops at the beginning of the year, they would have missed out on all the potential gains that we've seen in the market so far this year. So don't let these headlines deter you from your retirement strategy. Don't let these headlines deter you from having a good strategy and plan in place. And we'll talk about that in a little bit. So as I had mentioned, inflation drives Social Security. Recession can get into our minds. Inflation can get into our minds. All of this can get into our minds. So also, what does that mean from a retirement planning strategy standpoint? First off, let's talk about Social Security. Grab this from USA Today as well. And I can see how right now there's a lot of headlines out there, articles out there. They're just trying to grab your attention. Again, they get you to look at their article. They can advertise to you. That's how they make money. And so they're trying to make you feel like, oh, you're not going to get as much Social Security next year. Or actually, I saw one headline totally misleading about how seniors were going to lose out on Social Security this year. It's like, no, that's not what's happening. So let's just talk about Social Security. What does inflation mean for it? What does all of this mean? All right. This USA Today article actually did a pretty decent job, but there's some misleading stuff out there too. So despite the uptick in inflation last month, the longer-term trend remains lower, which means Social Security recipients will see a lower cost of living adjustment. Right now, it's a projection. Just let's understand that all of this stuff that you see out there right now about Social Security, it's a projection, but a cost of living adjustment of 3%. Well, of course, it's going to be lower. Inflation's down. So when inflation was skyrocketing, you get a larger Social Security bump. When it's not skyrocketing, well, we get a lower bump. I know you could potentially say it's not fair, but I think it's also fair that, hey, we've got rules that are set in place to give cost of living adjustments. Okay, so that's less. And then here's where everything gets misleading, right? Because it says that's less than half of the 4-decade high 8.7% bump that was given last year. Well, there's headlines out there to say, hey, you're getting a 50% cut in Social Security. You're getting, thousands of dollars. The average person's getting thousands of dollars less. Misleading headlines, because the thing is, you're still going to get an increase on your Social Security. If you're already taking it, you'll get a cost of living adjustment. If you're not taking it, behind the scenes, they give you that cost of living adjustment. So watch out for the headlines. Just understand Social Security is tied to inflation, and I'm going to tell you about that here in a second. Then based on the inflation, that's what gives you the cost of living adjustment. Yes, it's not going to be as much this year because inflation isn't as much as it was last year, but there is going to be a cost of living adjustment. How it's calculated, Social Security Administration bases its cost of living adjustment each year on the average annual increases in the Consumer Price Index, that's inflation, for urban wage earners and clerical workers, or CPI-W, from July through September. CPI-W largely reflects the broad CPI that the Labor Department releases each month, but differs slightly. So if you're wondering about Social Security and adjustments, you can look at CPI-W. When is Social Security COLA announced? The next COLA is scheduled to be announced in October. So all these articles you see right now, they don't have the final answer yet themselves. It won't be released until October. Everything right now is just a forecast based on where we're at so far in that July through September. Guess what? Right now they're forecasting 3%, but of course that can go up or down based on the August data, based on the September data. Everything's a forecast until October. So there we go. When it comes to Social Security, now we know what we're forecasting for next year, how it's calculated, and when it will be announced. So we'll find out in October what the Social Security COLA, cost of living adjustment, will be. So speaking of Social Security, if you're not yet collecting Social Security and you're wondering when to start it, when might be the best time frame for you? How can you get the most out of your Social Security benefits? We do have a free guide for you that you can download. You can go to lifemoneyshow.com/Social Security. Again, lifemoneyshow.com/Social Security. The free guide is going to help you get the most from your Social Security benefit, how to help optimize that benefit so potentially can give you hundreds or thousands of dollars more in your benefit. Again, you can get that at lifemoneyshow.com/Social Security. So wrapping up today about inflation going up, about whether or not there's going to be a recession, about Social Security going up, but it might not be going up as much as that you were hoping that it would. What does this all mean from a retirement standpoint? What are some just basic strategies here that we should make sure are incorporated into our retirement plans and retirement portfolios? Well, let's start with Social Security since we just finished on it. Remember, one thing is that if you're a couple and you're filing for Social Security, and you're worried about the cost of goods and services going up in the future, then one person may want to delay their Social Security as long as possible. Each and every year that you delay it, there's an 8% bump and another 8% bump. And then remember, when you finally take it, your cost of living adjustments are based upon when you finally decided to take Social Security. So I always recommend that if you're a married couple listening to the show, one person wait until 70 before they take Social Security, because if if and when one person passes away, you only get to keep one of the two Social Securities. Another thing, as I had talked about inflation earlier, and we said that their target was 2% for inflation, right? That's the Federal Reserve. They have a targeted 2% inflation rate for the United States. That is telling us that the cost of goods and services targeted by the government are targeted to go up each and every year. That targeted rate is 2%. That means that we have to include inflation in our plans when we're doing the retirement plans and the retirement income plans. That also means that we need to have equities in our portfolio. We need to have money that's growing at a pace that outpaces inflation. So your money will be there and last as long as you do. So I think it's really helpful to make sure that we've got a good equity portion in our portfolio that aligns with our income plan, our risk tolerance, and our time horizon. Last is having that retirement income strategy in place, putting together an income strategy, knowing all the sources that you'll have coming in of income throughout your retirement. Understand all of the expenses. Don't forget to add in inflation. Got to think about Medicare. Got to think about taxes. So that way you'll know how much you're going to take from your retirement savings each and every year. This is going to help you determine how much equities go into your portfolio. This is going to help keep you from going too conservative in your retirement. This will also help you set up your retirement guardrails. So all of this talk about in recessions, instead of letting that consume our minds and that consume our portfolios, well, instead, what we can do is we have our retirement income guardrails. We know when we need to tighten the belt a little bit when it comes to our income based on the account values, but also when we can spend more. This is going to help us find that balance between not having to worry about running out of money, but also not leaving a mattress full of money behind. So instead of focusing on recession, we can just focus on having the proper strategy, knowing that yes, the market's going to go up and down. If it hits certain points, we might need to spend a little bit less. We're not turning off the faucet. We're not running out of money. Just got to spend a little bit less. But if the market goes up, we understand when we can also spend a little bit more. Hopefully just that short conversation made you realize that we can do retirement planning without focus on any of these headlines. And instead, just enjoy the retirement. Just enjoy life. Just enjoy what you want to do today versus letting any of these headlines worry you. So hopefully you found today helpful. Again, if you are somebody who's not yet taking Social Security, don't forget you can get that free guide at lifemoneyshow.com/Social Security. If you're enjoying the show, subscribe on your favorite podcast player because we're going to have new shows coming out each and every week that are going to help you minimize your taxes in retirement, help you maximize your income, help you enjoy your retirement. So I look forward to our next conversation to helping you enjoy life today and being financially confident about your retirement.
Insurance products are offered through the insurance business Sierens Financial Management, Inc. Sierens Financial Group, Inc. is an investment advisory practice that offers products and services through AE Wealth Management, LLC, AEWM, a registered investment advisor. AEWM does not offer insurance products. The insurance products offered by Sierens Financial Management, Inc. are not subject to investment advisor requirements. AEWM and Sierens Financial Group, Inc. are not affiliated companies. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This podcast is intended for informational purposes only. It is not intended to be used as a sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual situation. Please remember that converting an employer plan account to a Roth IRA is a taxable event. Increased taxable income from the Roth IRA conversion may have several consequences, including, but not limited to, a need for additional tax withholding or estimated tax payments, the loss of certain tax deductions and credits, and higher taxes on Social Security benefits and higher Medicare premiums. Be sure to consult with a qualified tax advisor before making any decisions regarding your IRA. Sierens Financial Group, Inc. is not permitted to offer, and no statement made during the show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Sierens Financial Group, Inc.